Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, April 28th, 2022. Apple's just reported earnings. Amazon's out. Intel, handful of names. Majority of those are down. Robinhood was down. Amazon's down, but we're gonna talk on the ones that can move the market. So let's just we'll start here, and I'm gonna loop around and just talk about the fangs real quick. I'll keep this video relatively brief. I just want to share my thoughts, take a look at the charts, and tell you right now we've got all the earnings out of the way. The market leading FANG stocks have now all reported, the largest components. So the market is free to and will choose its direction here going forward shortly. And I'm also going to give you, ways to trade it. All right, Apple. Apple's up in after hours, but as I often say, and have said dozens, if not hundreds of times over the years, it is quite often not the initial reaction that sticks. Even if it is, you just can't put a lot of weighting into the initial reaction of a company's earnings report. After that comes a conference call. Apple conference call is going to be in 15 minutes. It's 4:45 p.m. right now. They call will be at 5 o'clock Eastern time. And it's about what they say. I hardly ever watched media, the financial TV, but I will turn it on market moving events like this, Fed meetings and all that, and I just try to get a collective sense of what those out there. And I know they're pulling in. It's not everybody they bring us onto the TV is not representative of the entire investment community, but for the most part, they were all bulls. The one guy who was the most, if you want to call it bearish on Apple, kind of conceded afterwards because they checked off, they beat on just about all. There's a lot of different metrics. iPad sales were down a couple percentage points, but everything else they beat: revenue, earnings, et cetera, et cetera. And so the stock is up. But again, it's about A, what they say in the conference call, and B, again, they can come out and also give completely rosy guidance here. One thing about Apple is the shutdowns in China occurred just as the quarter was ending, so that's not going to be reflected in this quarterly earnings report. Remember, there's a lag time of up to 4 weeks, 4 months. A quarter is 3 months. But then by the time they report a quarter, it's already over. It's been over for a month. So you have data going back, for starting all the way back to 4 months, and we'll see what happens. Let's just again, don't read too much into it. They're either going to follow through or drop. But here's the important things. Let's just focus on the technicals. We had the 60-minute divergence. And daily chart, I'm leaving the after hour trades on. So the candles you're looking at today are including the after hour session. So the big levels to me are this uptrend line right here, which Apple has been just tested the other day right there. Tighten it up a little bit, right? Perfect test with also successfully defending the 200-day moving averages again. It's not unusual to see a stock come down for a day, even a couple days, a week or so at a time, but not far. That's effectively successful tests of the 200-day moving averages. And then out here on the weekly chart, again, that same trend line right here, which we held so far, and we're above. So again, everything I've been saying up till now still has the potential. If this market's going to break down now, we're testing big support levels. The fact it was up today, big up day, means less than zero to me. Literally less than zero. We were down that much. We were down more than that the other day. So QQQ had a big day today, but they also had a big down day the other day, and that's what I just call earnings-induced noise. You can get it same like what I call the post-Fed noise when there's a big Fed meeting. The most important thing is, so far, we're still above support, and you cannot take that away from the market. Support is support until unless broken. The divergences are looking still very much intact right now. We haven't confirmed them, but stocks like, we had Microsoft the other day, and I pointed that one out, having positive divergence. If you look here, the PPO is curling up, poised to make a bullish cross. And these divergences are not the be-all, end-all, but they're good. They're one of the best tools in trading. And so as long as Microsoft has those divergences in place, if the PPO curls over. The next step is to cross it back above this line. You can see down here I have a yellow and pink line, and what that is, it's a trend indicator. It's the PPO. You look at the PPO signal line. So, guys, I can do this all day long, and I do. I know that I do these videos, and imagine if you're new to this, you're saying, well, one thing he said was bearish, and the next was bullish. I'm pointing out what you see. It is just like I often use the analogy of a criminal trial. Defendant is innocent until proven guilty, and it's the prosecution's has to present a case, and they have to be proven guilty beyond a shadow of a doubt. So, in other words, all the evidence, the defense presents their evidence, prosecution, defense presents theirs, and and the jury has to make a decision. And when you're trading, it's the same way. And so what I'm doing, I'm showing you things that are bullish, things that are bearish, and some things before they even happen, things to look for. So this is one big market leading stock. I just happen to come on this. I'm kind of ad-libbing this video here. But you can see when you're below it, the trend is bearish. When you cross below, these were big corrections. They don't look so big because I squished the price up top. But this is pretty bearish action. We're well below that now, but with positive divergence. Positive divergence is often going to come, usually does below the zero line. So again, it's a check mark for the bulls. That's what it is, or a minus, if you will, or an X for the bears. And again, the more checks you get, the better the case you build. So so far, so good for Microsoft, but this is what I'm watching for in the next week or two. If we can get a move down, boom. Otherwise, we could be looking at a rally, but again, it's far from all clear because many long-term trend indicators on many stocks and the market are still bearish. So in a nutshell, we still have a lot of the market leading stocks that support the index. We'll see what happens tomorrow. We'll see what happens tonight after Apple reports. But most important is going to be really what happens over the next week or so. Sometimes it takes a couple days for the market to digest that. And let me just show you something here on Apple. This is a daily chart, right? No, this is a daily chart right here of Apple. I'm going to move that back down. Made a mess of this PPO. I wish I had a different board. If I turn off all these lines, then the ones that I need to show you go away. What I have down here, all these vertical lines are earnings, including today, April 28th, last earnings, January 27th. And I've noticed over the years, that major inflection points come on or around earnings, very close or right on those earning dates. And so an inflection point, is when you turn. When you've been going down, you go up. Especially the major inflection points are after big drops. And what I was going to show you is this line here represents 1, 2, 3, 4 quarters, 1 year. So that was where we were 1 year ago on April 27th, Apple reported. And again, my apologies, I would have replicated this chart. I didn't think to do that. Try to look between all the lines. And that was a peak in Apple. And it doesn't look like much. I'm going to just tell you real quick. So April 27th, we peaked on earnings. Hunky-dory, was rallying right up to earnings, but it fell after that about 13% immediately following the earnings report. And likewise, a lot of those inflection points are also bottoms, I've noticed over the years. But I'm just going to circle real quick. This was a big one right here. We had a divergent high and a big rally, strong rally right into earnings, and then boom, a much bigger drop that time around. There was a bottom on earnings. There was a top on earnings. Nothing that one. It's not every time. That wasn't much of anything. There was a bottom after a big correction, earnings pop, and here we are now. So if it could be a big mover for Apple, maybe not. We'll see, and I'll show you this too. If you take that line, again, that was a year ago. This line measures the earnings. And so from here, April 28th to April 27th, the last earnings report. So if I move it this way, it just shows me where we were 1 year before that. The stock had bottomed just before that, and there was a big move up. And again, you can go back in time and see how this lines up right there with that major top right there, so forth and so on. I also did on the weekly chart. I have a line right here to show you that's it right there. And that a year after that. I just duplicated that line, add it to right there. Some charting programs, and I do have some that will do annual cycle lines. Unfortunately, this one doesn't. Annoys the heck out of me. Normally, you can just draw cycle lines, size them to any period you want. Stockcharts.com will do it. I just happen to be on this charting platform now. But you can also see that one came around that major bottom there. And again, the technicals say a trend reversal is likely in Apple. And I'm doing this video just right after earnings, after they blew the cover off the ball on just about every metric out there. And I'm telling you, there's still the potential to drop. Now, let me give you the trading strategy here. Okay, everything that I've seen over the last 2 days, if you last day or two was bullish. We rallied today. Remember, I did the video the other night right after Alphabet and Microsoft reported GOOGL. Remember, they got the snot knocked out of them in after hours immediately. That was the initial reaction to earnings, and then they rallied hard today. And Alphabet was up pretty big at one point in time. Here, I'll show you how big. You take yesterday's close right there, and at some point today it was up almost 5%. And again, just noise around earnings. That's all. Nothing technically significant happened. Microsoft, big winner, from after hours, or this doesn't show the after hours, but it shows where it closed the day of earnings. Then it went down, then it went up. It's up almost 8%. And again, very constructive chart right now, the positive divergence and all that. And so a case, I can say this, definitively, a pretty strong case can be made to go long here. You do what you want. You can go long. There's triple bottom support successfully defended, coming off the bottom, coming off impulsive positive divergence. There's a lot of reasons to go long. But you know me, I keep looking, and I'm looking at the long-term charts, and those long-term indicators, not all, but quite a few have flipped and remain bearish right now. And I put a higher weighting on long-term charts. So my kind of formulation, my working theory right now is this is still early stage bear market action, but I will pivot on a dime on those swing short trades. I'm still holding for now. And here, let me give you that strategy. So here's QQQ, right? That's main short, and we so far have, and this is a daily chart, 1, 2, 3, right? 3 successful defense, and when I say 3, there's 1, 2, 3 days, but that's a cluster. I consider this one distinct reaction. Come down here, another reaction, even though you hit that for, you hit it exactly one day, and then the last few days here. So we're above support. So TA 101, Technical Analysis 101, or Investing Trading 101 says you either buy support or wait for a break of it to short, and you could do that. Now, I'm going to tell you an aggressive strategy. If the market, which I suspect, based on my long-term analysis, right now, and again, that's what made me mention CNBC, they're all bubbly-headed bullish like they always are. Keep looking to buy these tech stocks. Everything's going down. And as I've talked about, one leader after another has been taken out, strung up to the post, blindfolded, and shot. Not all of them yet. Apple hasn't died yet, but Amazon's still well off the highs and trading down now, and most of them are Facebook we know has been annihilated. Netflix is down over 70, well over 70% off the highs, and many others, by the way. So last couple days, we had some positive tech numbers. Qualcomm came in good. Some other things that really, from what I can gather, turning on TV really charged up a lot of those, the fund managers, and they are by definition, 99% of mutual fund and hedge fund managers and money managers, they're bullish. Short sellers and perma bears are rare. There are some that are known for that. So you got to take that with a grain of salt. But if you turn off all the lines and forget about, the narrative is great. You turn on TV at any one point in time. They march these people out that have been in the business, and they make great talking points. But what I'm looking at is this is the trend right here in the Nasdaq 100. And that we pretty much made an equal high there. So that's a clear downtrend, and we just recently made a lower low. Okay, so that's it. That is what I'm looking at here, and this is an extremely contrarian trade. And again, I can take the other side of it if I wanted to, but in life and in trading, you can do one of 3 things, one of 2 things. You can engage the market, or on a position. Let's keep it simple. Let's talk about trading the indexes right now. You can either be long, short, or in cash. So really one of three things, right? If in cash means you're not sure, and that might be the best route for many, because I don't think we're going to sit here long. Either these divergences are going to play out and we're going to run up and have a nice rally and it could be powerful, but what I think is going to happen is based again on my long-term analysis, and I wish I had a stronger degree of confidence. This I talked about getting down here. I've been talking about it since we had that back test of the 200s. I was talking about it back here, that we'd get down to this level. So I wish we didn't have this, but you know what? They don't make it easy for you. And so what I'm telling you is, here's where we're at right now. This candle shows the after hours trading. A very aggressive, but I still think prudent strategy, a very nice risk reward would be if you have no position. I can only speak to right now. Let's just assume you have no positions and you are bearish. Short the market, put a stop somewhat above here. Let's look at the weekly chart. And you're shorting again. It's contrary to trading 101 by shorting right above support. But if all of a sudden the futures start tanking overnight, they're probably going to trap. If there's going to be a trap, and that's my experience in a bear market, is that it likes to trap the longs, those that want to get out, that were praying and wishing that oh gosh, if we could just bounce, I'll get a nice bounce, I'll sell my Apple, I'll sell my QQQ. In this nature of a bear market, especially a third wave down in a 5-wave primary cycle, it's very impulsive and it doesn't let the longs out. Just like a explosive rally off the bottom just doesn't give the shorts a chance to get out or the longs to get in. So this is the same thing in reverse. So what happens, you go up, up, up. Short sellers are just waiting for that one big pullback so they can get out of their positions, those that shorted too late or didn't cover. And then longs also that were too afraid to buy here, got shaken out, are waiting for a pullback that just never comes. And so I'm talking in scenarios. I'm just talking how this thing could play out, and we'll see. So then again, it's all about risk reward. So let's just say you did short the market now and after hours or tomorrow. If it's do it tomorrow, you got to wait to see where we're at. You might get a better entry, or you might be convinced not to short it. And I'll give you my thoughts tomorrow as well. Thing about it, if the futures move or if Apple moves after the call, you might not get that objective entry. And so now let's just talk, simple risk reward. So if you were to short, and I'm looking at the weekly chart. Okay, this is this week's candle. Again, it's showing the after hour session trades and all day. This is this week's, a little doji right now. But there's resistance. Remember, this was my former first target from all the way, this initial short and all these other shorts here. First target was hit, danced around it for a while, took it out, went above it. So that is resistance, and still is. It's not the best defined because we've sliced through it, but let's just measure this out. That would be a pretty wide stop, and I think you can use a tighter stop. But that's about, let's just go with that. That's 5.58. Let's round that up to 6%. 6%, and you lose if you short, and that's your stop. And if my final target is hit, you're looking at 27% downside. So that's a pretty nice risk reward ratio. That's almost a 4-to-1 RR. And that's the way I look at trading. And it's also, the other thing I factor in is it's not the highest probability. There are trades that I take and I have a very, very high degree of confidence they're going to play out. Right now, because of those bullish divergences, it might not. But again, based on what I'm seeing here on the weekly chart, I don't see divergences. In fact, I see typical bear market action, early stage bear market, where the PPO goes to make a big crossover, a bullish crossover after correction, like it did right here. See that? See when COVID hit? See the PPO got stretched, got knocked down below the zero line, came up and made a bullish cross. And see what happened this time around. That's what I call a rejection. When the lines come up, it appears the momentum's going, looks like everything hunky-dory, the correction's over, then boom, another leg down. The buyers fail to step in or follow through. And it just, again, it's simple stuff. It's not simple. The whole point of technical analysis and reading the charts is trying to gauge the supply and demand dynamics, and once that has shifted and you're just, the buyers have dried up and now you have more sellers, that's where a downtrend starts. Fourth quarter 2018, that was the other biggest drop that we've had in many years. And same thing, PPO went down, made a, bearish cross. That was your time to get out, just like it was here. Pointed out at the time, helped confirm, be short. And then you curl back up and you crossed over. But this is closer to, let's go back. I guess we'll go back to the last bear market. We had a crossover right there, bullish. That time we actually had a bullish crossover on the first drop, but look, it failed right after. Crossed over here. You probably can't see in the video. I realize that. Pull in right here. This was the last bear market, October 07, down to the lows there in early 09, late 08, double bottom really for the NASDAQ 100. And you crossed down below. You did. That bear market rally was a little bit stronger, gave you a bullish crossover, which quickly failed. Then the kiss right there. Then you came in and the lines crossed again. Second bear market rally attempt. And also, like I said before, it was a second rejection. Once you took out the 200-day / 40-week moving averages right here, you took them out. You came back a couple months later, tested one, test two, boom. And that's what happens, or what has happened then, and I've seen it happen before. You can study charts, go back in time. So look, all right, the takeaway is I gave you one strategy that's objective. Go ahead and short now. And have a stop that you want. If you go too tight, you might get stopped. That's always the downs, or the what do I call it? The hard part of trying to determine a stop. A very tight stop, you're going to obviously lose less if your stop is hit. But in a volatile market, you're more likely to get the stop clipped, meaning popped, and then your move, the move that you were calling for or positioned for, ends up playing out, but you got stopped out because you ran too tight a stop. In this market, if today didn't tell you what I've been saying for a long time, these 3, 5, 6% up down days are the norm now, and that's what we saw today. You can see what the today looked like. There's where we opened. At one point before the close, the NASDAQ 100 was up 4%, and now boom, fading a lot of that so far. I even gave you guys a I give you a little setup. Well, it says 1 second ago because that was when I posted it earlier. Under the last post, your comments, I'll have to catch up on those. Little pullback trade before the close. Minimum, underlined and italics and bold, meaning at least pullback of 1.5%. This was a nice level. This is a 10-minute chart of NQ. This is as we're heading into the close today. Negative divergence there on the RSI. Nice clean uptrend line at resistance. Boom. And so that was about a better than 1.5%, 1.8 down to 13,319. Let's see where we're at right now. That's it. So that was hit. And that was right on the button there. Boom. Overshot it by a hair. And here's a trend line that we're walking up right now near term. If that trend line breaks, you've got a little bit of support right here, about 12,947, then the low, and then that's it. After what happened the last few days, if Apple, if the market doesn't like what Apple's going to start selling right now on the conference call, which started 7 minutes ago, and we go down through here, it's going to wipe out all that bullish action over the last few days. The Microsoft and who else did okay after that? Qualcomm, some other companies. That's going to be wiped out. And if we go much lower than that, you're going to break support, and you have the potential then to take out the divergences. So I'm going to wrap it up here. QQQ still above, but at support, not far from it. That keeps that crash warning on the markets. In other words, not a watch, a warning, because we're in such close proximity right now. It reminds me of that scene on Saving Private Ryan. I'm a movie buff, when they're storming the beach in Normandy, when I use that analogy today, but no, I didn't mean to bring that up, but there's a little scene where the guy has one of the Allied soldiers, a bullet bounces off his helmet, he takes it off, the guy looks at him, that's next to him looks over at him and says, wow, with that look in his eyes, like, what a lucky SOB. and then a second later one catches him in the forehead, and that's it, and he's gone. And that's what it feels like happened right now. Especially turning on TV, and I just know how everyone was. They figured that's why the market rallied so far hard today. Everything that I figured would happen first, that big drop we had earlier in the week after Facebook and Netflix were taken out to the shed. I'm sorry, Facebook had the positive divergence. Facebook was the one I told you right before earnings looked the best right there, had strong divergence, popped so far. But again, it had already been taken out to the shed several times on earnings. This one was already down 50%. That's why I said if anything, I'd be long that one, not short it. It had dropped 55 off the high. And by the way, that's nothing but a bear market rally. That's a big gain in Facebook, but nothing. I mean, not even close to even, I won't even put up fibs right now because they're not even going to register. This is a stock deep in a bear market, and this is what bear market rallies look like. In this stock, it could go all the way up here, and a good chance it might all the way up to that 245 level right there, bottom of that big gap, and it's still only going to be a bear market rally if it gets rejected there and heads down, which I think it probably will. So. All right, I think I've said everything I need to say. Apple blew the cover off the ball, but again, that is, to me, completely insignificant and irrelevant. What is important is what the market does with Apple going forward. Apple has a history of making some big moves after earnings. Doesn't always have to be a pivot or a turn. We have been heading lower. And like everything else, Apple is in a downtrend. Apple did peak. Apple peaked along with the S&P 500 back in late December, early January, where the rest of the NASDAQ 100. So this is what I've been talking about. This has been the last of the holdouts. When you look at QQQ and the top components of the S&P 500, Apple really the strongest one, especially here we'll look at it on the weekly chart. But then you see Microsoft already down, down to support, and it rallied. It's been trading on support, and it rallied last couple days this week, but it's still sitting precariously close to a key support level right there, and it is still down 22.5% off its highs. Alphabet still down off the highs 26%. Amazon down after earnings, things slowing down for Amazon so far from today's, would measure today's low, I think. Yeah, that would be with the after hours trading and all that going on, but one to watch, because here's the bull market uptrend line for Amazon. I have a trend line going back to when the stock came out public back in 1997. That's that blue line, and it's at risk of undercutting that, as well as some pretty good price support. So that's it. I know I'm beating a dead horse here saying the same thing over and over, but despite what appears to be that kind of reprieve from just because not all the stocks that reported over the last few days got annihilated. Some of them actually came in and beat, and they got bought up. But remember, they got bought up. Almost all of those that have rallied, especially the biggest ones that rallied the most lately, like Facebook, got bought up deeply in a bear market. All those stocks down over 20% or more. So it's not like they broke out to new highs. Went up 15%. No, they dropped, 20, 30, 50% or more, and they're just oversold, and you can get that short covering and dip buyers coming in. So all right, let me wrap it up here, and I don't think there's anything else to say. I still think, although I can't say it with the highest degree of confidence, I think that everything, although a great bullish case can be made, and I do get, well, from a fundamental perspective, most analysts on TV, they're talking fundamentals. Why the reasons they buy. I'm more of a technical guy, although I can sit here and talk the fundamentals all day long, as I did today. We see GDP for the went negative by a pretty good amount. This today for the first quarter GDP, we're seeing the Fed not only beginning a rate hiking cycle, but what's been widely acknowledged even by them to probably be one of the most aggressive rate hiking cycles in decades, because of the rate of inflation. So you want to talk fundamentals? To me, I'm shocked the market's still where it's at. I'll be honest with you, based on where things are likely going. Because remember, the market looks 6 to 9 months ahead. The consumer's holding up, and that's the story I hear. And I have to acknowledge the consumer's still spending. because they overstimulated this economy so much, giving everybody checks, PPP, free forgivable loans for all business owners. And, that money is still there sloshing around the economy. But this is where I think we're going. And we'll know soon. And if I'm going to pivot, it'll probably be next week. By pivot, I mean starting to cover some of those long-term short positions, swing short positions, and or maybe even get long. So I'm going to end it here, and I will follow up probably not tomorrow morning, even if the futures go down tonight, or if they go up. We'll wait and see. Let's see how the market trades tomorrow during the regular session, and I'll get my thoughts out to you. And any other trade ideas. I know I've been hyper focused on the market lately, but that's kind of where I've kind of reeled in. Natural gas and crude are kind of doing they're floundering around, and the other things, lumber, things that was trading before. I'm still long gold and silver and treasury bonds. Those I still like. That's still, as I've been saying for weeks, my core positioning. Um, my longer or intermediate term outlook is bearish equities, so short stocks, long bonds, and long gold and silver. Those are just my core trades right now for trend trades. All right, we'll wrap it up right here. This has been Randy Finney with Right Side of the Chart. Have a great day.